using a math-based approach gives you a definitive way to define things. When you have to define a trend mathematically rather than just what it feels like, that is different. And that having that math-based approach where we're mathematically defining things allows us to really get our emotions out of the way. And emotions can be great, but they are really antithetical to investing success.
Welcome to Sterling Insights, Stand Out and Supercharge Your Assets, the go-to podcast for financial advisors aiming to grow their assets under management, stand out in a crowded market, and retain assets nearly forever. Are you advising high net worth clients who own appreciated capital assets? Do you want to help them sell without losing a quarter, a third, or even more of their hard-earned profits to capital gains taxes? Then this podcast is tailored for you. Each episode brings you the latest strategies and expert advice from leading financial advisors, seasoned attorneys, and experienced CPAs. Learn how to maximize your clients' wealth, minimize their taxes, and supercharge your advisory practice with actionable insights. Join us on Sterling Insights, Stand Out and Supercharge Your Assets, where you'll gain the knowledge and tools to set yourself apart and achieve unparalleled success in wealth management. Subscribe now and empower your practice for a brighter, more prosperous future. Welcome to Sterling Insights. I'm your host, Roger Silk. Our guest today is Greg Luken. Greg is the founder of Luken Wealth Management. He's a longtime advisor to first-generation wealth, people who've built their success from the ground up. Greg has nearly 40 years in the industry, and he blends math-based investing with real-world experience to help clients convert hard work into lasting wealth. He's also got a new book out, Unleash Your Financial Superpowers, and we'll be asking about that. Greg, welcome to Sterling Insights. Thank you for joining us.
Great seeing you, Roger. Thanks for having me.
Appreciate it. I'm always interested in that mixture of math and real world stuff, because to most people, those two worlds never meet. Want to give a little bit of explanation about what that is and how people ought to think about it?
Sure. If you think of paint by numbers can help you have success if you're not super artistic, and using a math-based approach gives you a definitive way to define things. When you have to define a trend mathematically rather than just what it feels like, that is different. And that having that math-based approach where we're mathematically defining things allows us to really get our emotions out of the way. And emotions can be great, but they are really antithetical to investing success. So it's been helpful to us, and I think helpful to clients, to have a math-based approach to look at and say, hey, we just want to put the probabilities in your favor. That's all.
So are you doing some kind of trend following, or what kind of math do you use?
Yes, it's basically mathematically defining trends. We irreverently refer to it as the Kenny Rogers approach, and young listeners may not know who that is, but he was the guy who sung "The Gambler." You have to know when to hold them, you have to know when to fold them, and you have to have a clear way to know which one you should do. So those three elements, having a game plan for up markets, having a game plan for down markets, and they're different game plans for us, and then having a clear way to delineate, to differentiate between those markets is helpful, and doing that asset class by asset class.
So Greg, you've been doing this for about 40 years.
Yes.
Okay. So where is the business now? What's the current state of Luken Wealth Management? Just from a 50,000 foot overview, who do you serve? How many of you are there? That kind of thing.
Yes, we have a team of nine. We serve first generation wealth. We serve the wealthy of first generation, the people who made it themselves. And as a wealth management firm, that term has really been watered down a lot, but that means we're looking at tax strategy, legal strategy. We're looking at the financial planning, the cash flow, the debt structuring, as well as the investments, because there's a lot of things that impact people's wealth beyond just the investment piece.
So you focus on first generation wealth. Is that mainly entrepreneurs or is it executives or what's that client base look like?
Yes, those are the two, if you want to call them profiles, the two kind of ideal clients are top performing professionals, whether they're executives or, they may be attorneys, CPAs, professors, surgeons, but really those people at the top of their profession professionally and entrepreneurs. And it's about 60-40
Which
between the two.
way?
About 40% are entrepreneurs
Uh-huh.
and
By
about
count.
60. Yes, by count.
Uh-huh. Uh-huh. So I would guess to a first approximation, the job is for the professionals is to help them essentially convert their human capital, which they turn into cash on an annual basis, in sustainable financial capital.
Absolutely. And with first generation wealth, there are a number of things that get in the headspace that can help prevent you from getting there. And there are a number of things in the headspace once you are there that can prevent you from staying there. And Roger, it is so common. We see this story played out over and over of people create the first generation wealth, but then they lose it. And it's easy to point to kind of the high profile, the rock star or the professional athlete that makes it and blows it. But the reality is about 1 out of 3 decamillionaires won't still be there. They won't still be decamillionaires a decade later. Um,
So that's somebody with 10 million. Is that what you're talking about?
yes, sir.
So you're saying that 1 out of 3 people, that's really interesting. Doesn't have to be an actual person, but just give an example because I think many people would find that surprising. How does that happen? Tell a story about that. A guy who,
Yeah. So met with a gentleman 2 years ago, exited his company after tax, had about $16 million. He excuse me, 4 years ago. 2 years ago, he started another company. In the meantime, he bought another airplane. He already had an airplane. He bought another airplane, not a jet, but a plane. He bought a really nice car.
it has to be a really nice car to make a dent in 16 million, wouldn't it?
Well, not just the initial $350,000 price tag, but the maintenance and the storage, and there are things that go along with that. So the he did get divorced. He started another company because he knew how to do this. He ended up with a 40 to $45,000 a month cash burn. He knew he'd have that for a few months, but 2 years in, he's still at $35,000 a month burn, and so he's seeing this $16 million, down. He's not broke. He's got still has 4 million of it left. But when you've been at 16 and now you're in your mid 50s and you're down at 4, it really feels like, hey, the screws are starting to tighten. And then decisions start getting made differently, right? Because now you're in a different headspace, and we see that story repeat over and over. It's not that he's a failure or lost all his money, but action has to be taken to stem the
Uh-huh.
tide.
Uh-huh. That's a very interesting case. How would, I mean, if you or he could go back in time and you would tell him, hey, here's what I recommend you think about. Here's how you should be thinking about this. Like he sells, he's got 16. What in an ideal world, what does he do that has a different outcome?
Well, one thing is to clearly define what success looks like, and then put money, whether you think of it in tranches or in silos, but put money that has a specific job. And when you start a business, the job of a business, the job of those dollars is to create a profit. And what's happened without clearly defining, here's what we'll do, here's how much we'll allocate, then it becomes, well, we just have to start feeding the beast. Or when you buy the car and the airplane, and you have that maintenance and those ongoing costs, there also becomes an attachment issue, right? So you get down to this concept of, do you own your stuff or does your stuff own you? Who's the boss, right? Like the old
Right.
TV show.
Yeah.
I'm dating myself again. Who's the boss? Your money, or are you the boss of the money? And so what ends up happening then, we have these things that get in our head. Well, all my friends know I have this car. If I sell this car, what will people think of me? Is that a sign that I'm failing? So then I end up hanging on to things too long that or I started this business and it's not working now, this new business. And am I making decisions that same rational way? Or am I saying, well, I had this successful business, I started this one, I can't close this down. And yet, dollar wise, that very well may have been the best move years ago.
Mm-hmm. Mm-hmm.
So really, really thinking about things in boxes, tranches, silos, so that here's the money I have for this. These dollars have this job. If they accomplish that job, that's great. If they don't, no mas.
Uh-huh. So I'm guessing that that's sort of an outlier among your clients, or that's not a client.
He, I wished he had been a client.
Yeah. Because then
Yeah.
he'd probably have 25 now.
And so we like to see people get a game plan that gives them a high probability of their outcome, the outcome that they want, whatever that is.
Mm-hmm.
And then let's make sure we're monitoring that closely along the way. And if something's not working, the best time to cut it is early.
So if your entrepreneur clients, you start working with them when they're, I guess, at various stages, or do they typically come to you after the business is established and it's thrown off a lot of cash, or how do the entrepreneurs come to you?
Great question. It's usually after the business is established, it's working, and it's throwing off some capital. Oftentimes they're at the point where they're saying, hey, I'm 5 to 7 years from an exit. And we start having conversations at that point about what needs to happen to really get your business situated in a way that gives you the best opportunity, whether you find a strategic buyer, or an opportunistic buyer, or a vendor or an internal transfer, so that you have time to build that out and really take advantage of the fluctuations and valuations that happen with private companies as well.
Are you involved in actually helping them plan the exits?
Not from the standpoint of getting into uh, operations or the books of their company. That's really a specialized niche, and we want to make sure people are working with professionals, and professionals don't do everything.
Do you Would you be involved in maybe as a quarterback or on that team of just like John Smith is looking to exit, but obviously he's most likely never exited before, since most people do this once
Right.
or zero.
Yeah. Well,
Uh,
I can give you a great chicken or egg story.
okay, always
So
like those.
yeah. So last year, a business owner called us and said, I'm trying to figure out what to do, but it's like the chicken or the egg. Said, somebody's telling me, well, just tell me what you sell your company for, and we'll invest it and tell you how much money you can get. And he said, I've got a valuation. I'm trying to figure out, when should I pull the trigger? How do I do it? How do I structure the deal? I don't know if I can afford to sell this year. I don't know if I need to, ride this out for another 5 years. And so we really clarify what we call a wealth roadmap, that picture, clarify the values, the goals that support those values, and then the plan becomes really a lot more evident. So we were able to say, here is the range of valuation today that would get you where you want to be. And it just so happened to be right in the middle of the business valuation. So it gave him the confidence to say, if I get somewhere in this valuation range in 2024, I can end up with the life I want with the finances to support it and really get some of the stress off of me. And so it allowed him this 2-year process he'd been going through where he didn't feel like he could even get to the starting line. And we said, yes, if you get this, then you can do it this year. If you don't get this, and it's 3 years from now, then you need to be driving valuation to here in order to get the money it will take to support the kind of life that you want.
So is it a sort of a situation of the guy's been working, and so the money to support his lifestyle is coming from money he's taking out of the business one way or another. But
Right,
when he sells it, he's not working anymore. And so
right.
now that you have to have a capital amount that produces a similar cash flow.
Exactly. And so figuring out what that looks like so that we take that ambiguousness that, hey, I want to retire sometime in the next 5 to 7 years, to where we can say, look, if you want to close the transaction March 30th, 2025, you can do that, and you've got to check April 1st.
Uh-huh. And then you've done the work, presumably, that if we invest it in this particular way, you can take such and such an amount of cash flow every year. Is that kind of the thinking?
That's the way we structure it. Absolutely. Because when you invest for income, obviously there's a different pressure that's put on a portfolio that has to generate that recurring income that you can take to the grocery store or corner bar or wherever it is you want to take it on a regular basis. But that produces a different pressure on a portfolio than just, hey, I can just leave this money sit and hope that I make money in the next year or 5 years.
When you have somebody in that sort of situation where they're going to sell their business and live off the cash flow, what kind of spendable, how do you look at how much can somebody afford to,
Just
yeah,
to spend
basically,
on.
so I mean, if it's a yield on a portfolio or a multiple of the cash that they're going to need, I just want to know how you think about that.
That's a great question. So what we do is look at how much income needs to be generated by the investments, because they may have a pension, they may have other stable income. I mean, Social Security is an obvious one, but for most affluent people, Social Security is not really the bedrock of their income. So we look at, what does that income need to be? And just an easy rule of thumb, if you look at the 4% rule, whatever the investment income needs to be, taking that number and multiplying it by your annual number by 25, that kind of gets you that baseline. What we encourage people to do is multiply it by 33, which gets you a 3% distribution rate. So that gives you a much higher margin of safety. And of course, if you can multiply it by 50, you have an annual income need of 100,000 and you have 5 million. That's much safer. And so that gives you a lot of flexibility that other people don't have. And interestingly enough, our two chronologically oldest clients have virtually all of their investments in a stock portfolio, because they will tell you. One wonderful lady we work with, Anne, is in her mid-90s, and she says, this money's not really for me. It's really for my grandchildren. And I get all the income I need off the dividends. So the dividends are creating this income, and she has such a multiple relative to the income that she spends that her her framework or her frame on making that decision is I'm not really investing for myself like I'm, 94 years old. I'm really investing for future generations, and I get plenty of income from the dividends. And so, what a great place to be
Yeah.
from a sense of freedom.
Yeah, for sure. What's the sort of business valuation ranges that your entrepreneur clients are looking to exit at?
Well, everybody wants 25 to 50 times EBITDA, but we're
Right.
not there. And so what you tend to see are, depending on the industry, depending on the margins, that sort of thing, we're seeing a lot of things in the 7 to 18 times EBITDA. If you're looking at multiples of revenue, some service businesses that really operate off that, we're seeing somewhere between 2 and 6 times revenue, which really kind of oftentimes backs you into a very similar exit price. But
Uh-huh. And then are most of these, how many people have you had already exit and how many are like probably teed up in the next, say, 5 years of existing clients?
I would say the probably 70% of our clients are not living off of their portfolios. I don't know the exact number, but I think about 30% of our clients are taking that steady income, some of them in their 40s and some of them in their 60s or mid 90s.
Yeah, at least one.
At least one. Yes. And I think for first generation wealth, it's really hard to think about that because they've spent most of their life working, plying their
Hmm.
trade,
Hmm.
whether
Hmm.
they own a business or whether they're writing legal docs or performing surgery. They have spent so much of their life focused on being a good craftsman at what they do. The whole idea of just living on the investments is psychologically really a challenge,
Oh, yeah.
right?
Yeah.
Because we get so much of our identity, I guess,
Hmm.
tied
Hmm.
up in not just who we are, but what we do.
I totally understand that. Yeah, and I think that's very common to see that with especially people who, in order to become your clients, they've had to devote a large fraction of their waking life to building you're
Right.
what they're thinking about walking away from.
Right.
Although
And that
do you see some people who, even if they sell, whether it's a professional practice or a more entrepreneurial business, but the way that they sell, they stay on, they stay involved, maybe stay working for the buyer.
that is really common, and most what we've seen is most buyers want that entrepreneur to stay on. We've seen it last anywhere from 3 days to 3 years. A couple instances where it's longer than that, but there is a sense of getting continuity, and the seller wants to make sure it's successful for the buyer, right? So
Oh,
they want to
absolutely.
make sure the buyer's successful. They want to make sure that the customers or clients of that business continue to get a good result. And one of the biggest concerns we see is they're concerned about their team. They want to make sure that their employees have a great transition and a good experience as much as they can impact that.
Yeah.
It's I think, for anybody that can be a stretch. I think for first generation wealth, that is always a real challenge because they've had that foot in the old world where they didn't have, life was simple. They didn't have money, and now they have moved to a lot more complexity in life. And I was talking to a CPA this morning, and she was commenting. that, hey, I've wanted to be a CPA all my life. At 9 years old, my parents were talking about, depreciation schedules and what they were doing with rental property. And this all just seems like,
What else would you talk to a 9-year-old about?
and, so now she's in her 20s and she says, well, I've got this successful accounting practice and I just can't believe people don't know all this stuff. I knew this, before I was in high school. And that's great. That's great for her. But most people who are first generation wealth did not have that experience.
Most people who weren't first generation wealth, whether they were or not, they didn't have that experience, right? Not sure I've really ever run into somebody who was learning accounting at 9.
Yeah.
Right?
Yeah. I think it was about that age. I think it was about that age that one of my kids asked my wife and I, they said, how did you both get to be the boss of your business? Do you all take a vote or do you take turns or, how did that happen? And so it's just interesting how
Yeah.
kids have
Yeah.
their perspective.
Unfortunately, we're pretty much out of time. I did want to ask you if there's something that we haven't gotten a chance to touch on that you really wanted to make sure that the audience knows.
Well, thank you for asking that question, Roger. I think that a couple things. Number one, there is a real fluidity to wealth that I think most of us don't appreciate. Just because you end up with 1 million, 5 million, 10 million or more doesn't mean you stay in that position, number one. And number two, what affects that really are mindset and the way you make decisions around taxes and investments and getting clarity on a plan. Those are the things that have the biggest impact. So it's not about intellect or education. It's really about just doing the basics really well.
Well, that's I'm sure people can learn a ton from you. Where can they go to learn more about you or contact you, learn more about your firm?
Thank you. Our website is luken.pro. It's luken.pro. And we have a resources tab there to help people if they're just looking for information. And there's contact info there and information on the book, Unleash Your Financial Superpowers.
Super. I'm sure everybody will want to look for that. Greg, thank you so much for joining us. Fascinating.
Have a great
Thank you.
day.
Thanks, you too.
Thank you for listening to another episode of Sterling Insights. Stand out and supercharge your assets, where we provide the info you need from successful leading financial advisors, lawyers, and CPAs. Your hosts, Roger and Catherine Silk, invite you to learn more about Sterling Foundation Management by visiting sterlingfoundations.com.